Hello, welcome to our podcast on 23rd of December, our final one of the year. So, what we're going to do initially, I'm just going to have a review of what happened last week. We can find out, have a look through some of the tea leaves to see if that helps us gauge what's going to happen coming up. Thank you, Kate. That's great. Kate can hear me. Mark can hear me. There's a David can hear me. Good, 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 good. That's great. Um, and once we've done a review, we're going to sort of look into the murky world of predictions and what people were expecting this time last year and what they are looking for next year. You could say it's a bit of a mugs game, but the press is full of it at this time of the year. So it's something that we can discuss and explain why we're not great fans of it, really. But anyway, let's have a look at so what happened last week. Markets had another positive week. It gets and starts to sound a bit boring, really. If I show you, this is the DAX, the German stock market. Not the best example of a market, but still a market that's done very well this year. I could show you the S&P 500. That continues to power ahead, making new highs. It has very few blips, doesn't it? This year seems to have been characterized by a lack of massive black swans. Nassim Taleb's description of those earthquakes that were tending to hit the market more frequently than perhaps we would all like. The last one really being December last year, if you cast your mind back to what was happening at the end of um, 2018. If I can get right back to it, it needs to be compressed quite a bit more than that. There we go. So we can see this is the end. In fact, if I blur it up, you can actually see one of the most interesting candles happened when we were asleep. This is this candle here on the 26th of December, Boxing Day. And no, they don't have Boxing Day off in the United States. The markets are open, and it was a massive outside day, an engulfing candle. And since then, the market has rallied significantly. So you could say we all started the new year with the markets quite depressed, but nevertheless, they have eclipsed their previous um, highs by something and continue to do so. So this was the previous high here, but as you can see, as I expand it, you can see that the markets have just gone higher and higher and higher. More about that in a second, but an extraordinary move nevertheless. Um, Let's have a look at some the markets in general, and I can then comment on them. The FTSE 229 points higher last week, 3.1%. Okay, right. I've got a question here. Why did the FTSE rally in such a dire week for data? Dire week for data. Was it? It was quite a dire week for data. UK. Yeah, it certainly ended at the end of the week. We had GDP data slightly better than expected. Retail sales, that was it, was a lot worse than expected. And we had data earlier on in the week that wasn't particularly good. Services PMI, so at the beginning of last week, 49, expected 49.6. Manufacturing, so not just manufacturing in the doldrums now, services are as well. So not brilliant reading for the UK economy. And you'd wonder why the FTSE had gone up. Well, it's a very good question. Are the FTSE really benefiting from the slide in sterling? And that's the thing that has helped the FTSE. And this is sterling here. If I just zoom into it, you can see what happened at the end of, well, really over the last 6 days, isn't it? You can see after the post-election where we hit sort of 135.10, we're now trading 129.74. So it's fallen below 130. I don't know what you all think of that, but I wouldn't get, I wouldn't, it's very much a buy on rumor, sell on fact. They're talking about what's happened to the Boris bounce. The fact is, there's a long road ahead with all this trade negotiations to take place. So I think anyone deciding on the merits of next year on the basis of what's happening now is probably throwing rolling the dice probably. My suspicions are that it'll ebb and flow sterling as the negotiations take place, but I think it's going to I think it's going to turn out more positive than I think quite a few analysts are expecting. So sterling basically, in a nutshell, has benefited from the slide in sterling, and I think that really started with poor data, yes, towards the end of last week, but really when Boris Johnson announced the fact that there was going to be no flexibility on the trade negotiations end date, which actually I understand. Why would you go into a negotiation and say, well, if we don't get it done by December, we'll just keep on negotiating? It just really means that the EU, who are in no rush to conclude a deal, will be in no rush to conclude a deal. So it makes a lot of sense. Unless I don't know what everyone else thinks. Do we think it's a positive move, a negative move? Like some of the left-leaning press believe it's Boris Johnson attempting to push through a no deal again. Other markets, the Dow Jones and S&P, well, they carried on rallying, didn't they? Dow Jones up 319 points last week. I think that's less than 1%, obviously. The S&P 500, well, that's the broader market that the asset managers follow more closely because it includes all the top companies in the United States. It's the top 500 companies by market capitalization, and that was up 52 points, 1.6, 1.7%. The DAX was the one that didn't do so well, and we know why the DAX didn't do so well, because the euro was rallying. Here's a snapshot of the euro, although it has come off in the last couple of days of last week, but it had been quite strong, which had been depressing the DAX a little bit. Remember, that affects the big exporters in Germany. But you think, the euro would start to react quite positively, especially with the phase one of the US-China trade talks sort of being concluded, or at least that's what we've been told. Other markets, Nikkei down 206 points last week. Not really much to say about that. It's one that's not the best performing markets last year, but that's something we'll get on to in a second. Currencies, well, we just looked at the euro here, modestly lower on the week, following quite a fall on Friday, and that was on the back of some rather poor data Friday. And that was maybe it was Thursday. Am I making this up? I don't think I am. Anyway, I had some bad data that came out in Europe, and maybe it's the data from earlier on in the week, but okay, that's not something that's so obvious at the moment. But anyway, sterling was the big faller last week. We've mentioned it already, but that fell just over 3 cents, which is about 2.4%. Yeah, as I said, it's the Boris bounce running out of steam. I think investors and currency traders are reminding us all that there's a long road ahead in concluding a trade deal with the European Union, the EU. Anyway, I'm sure we'll be talking about that a lot in the new year, as we have to. But gosh, more Brexit. Anyway, gold up $3 last week. Nothing really to say about that. Perhaps the price of the dollar, with the dollar firming, it sort of counteracted it a little bit, but a slight pickup in global macro events. And I think the fact that oil is rallying is also helping gold, ironically. UK oil up $1.10, which is what, 1.7%. US oil, not quite so much, up 57 cents. But if we look at the chart here on Charting Center, you can see where UK oil has been going, and it's been going up. Boris is correct. Negotiate with a stop date, says Brian. Well, I think that's spot on, Brian. And I agree with that. I don't go into meetings in my company and have a meeting that's like, oh, you just carry on talking till you finish. You said, well, this is booked for half an hour or 45 minutes. Otherwise, people will talk about their kids, Christmas, football, God knows what, and you don't get anywhere. But Brian, spot on. I agree wholeheartedly with you. So this is the price of a UK oil, or what's referred to in international markets as Brent crude. It's the international benchmark for oil rather than the US oil, which is WTI, West Texas Intermediary, which is more of a US domestic oil. But Brent, this particular one we're looking at, really is the one that global markets follow, and it's clear to all of us looking at it. It's particularly strong at the moment, and remaining strong. Friday was a bit of a sort of profit taking after, golly, 2.5, 3 weeks of strong gains, really. Uh, Oils. Why oil strength is a question I've been asked. Reasons for oil's continued strength, I'd say, following the OPEC meeting, which I think just demonstrated that OPEC's ability to control this market is not lost yet, even with the US outproducing OPEC's top producers, so that's all the US shale oil. And I think this agreement regarding phase one of the US-China trade deal has also added to the sort of positive tailwind pushing crude higher. Um, Okay, here's another one. Why has petrol and diesel jumped so much on the forecourts? Well, I've pretty much summed it up, really. We've seen it has jumped, hasn't it? Actually, gosh, yeah, I remember. I don't know, I fill up yesterday or the day before. I was surprised how expensive it was, especially in Leighton Buzzard. I don't know why Leighton Buzzard is especially expensive, but it's a double whammy of a jump in oil price and the weakness in sterling. Remember, as sterling weakens, that's the dollar strengthening, which in because dollar crude is priced in dollars, so petrol and diesel they're all uh, priced in dollars, but then they and translated into sterling. If sterling's weaker, it's higher in the price of when converted to sterling. So it's a bit of a double whammy: higher oil price and a weaker sterling. I'm afraid. Great Christmas present for us all, and of course the usual moanings that I run out, and I'm sure all of you do, whenever the price of oil jumps or whatever negative factors push the price up, they're very quick to raise the price. But whenever oil comes off, do you ever see price fall quickly? I don't. You probably don't either. Anyway, there we go. One thing I want to then now talk about is what's happening this week, and you won't be surprised to know there's absolutely nothing to talk about. And the reason being, this is the holiday, Christmas holiday week, and I'm showing you this just to prove it to you. It's all holidays. We've got there's even a German holiday tomorrow, so there's quite a few. There's a few countries in Central Europe that are on holiday. We finish at 12:30 here in the UK. Certainly our stock markets do. So an early closing at 12:30. We're obviously closed all day Christmas Day and Boxing Day. Same thing New Year's Eve, although that's not on here. New Year's Eve, the UK markets also close early at 12:30. Okay, hang on, one more question from a John here. A John is asking, what about US markets? Okay, US markets, they close early tomorrow as well, and it's 1 p.m. That's sorry, that 1 p.m. Eastern Seaboard time, which is 6 p.m. here in the UK. So that's effectively 3 hours earlier. So the US markets close 3 hours earlier tomorrow. They're shut on Christmas Day, as indeed all markets are, global markets are. But on Boxing Day, US markets are open, so don't get fooled by us having a holiday. The US markets, you can trade US markets on Thursday if you wish. Then our markets are all open again on Friday, Friday the 27th. That is okay, good. Any other questions on that market timing, etc.? Okay, let's just have a quick run through then. So that's all the holidays taken into account. So as you can see, there's nothing coming out this week. The one bit of data coming out is actually today, which is the core durable goods orders. It's called the core durable goods order because we exclude, or they exclude, some very big ticket items like airplanes and stuff like that. But and Boeing's aircraft sales, I suspect, are taking a bit of a hit. But anyway, 1.5% is the prediction after zero point 0.5 in November, which was revised down from 0.6. That's the only bit of data until the end of the week. If you trade oil, and you normally like to see the crude oil inventories, which are published by the Energy Information Administration, that doesn't happen until Friday at 4. If you are trading, and if you are around, you're going to have to wait till 4 o'clock on a Friday. The reason is because of the bank holidays, so it takes them a while to collect this data, and if there's a federal holiday, then it puts them back by a couple of days. Hence the reason why it's not Wednesday, it's Friday. So there we go. Right, what I want to talk about now, and we've got, I've got about another 10 minutes. I just want to talk about really this time of year, a lot of analysts, a lot of economists start to talk about predictions and what's going to happen in 2020. Um, I, like you, probably are interested. I read a lot about it all, and I'm like, oh, really? Is that what's going to happen? Do you know what? Every year I listen to this, I read about it. I don't think many analysts get it right. You can tell me if whatever you've read, people have got it right. But I'm going to show you a few things in a second. But do they get it right? It's a bit of a mug's game. I think economists are sort of duty bound to offer their insight because, let's face it, that's their job. Okay, that's their job. So I think I'm not sure what's happened here. I've got some interference. Hang on a second. Who's ever logged into? Can you log out, please? Apologies about that. We had a bit of a crossed line on that. I hope you can still hear me. Um, anyway, yeah, I feel a bit sorry for economists. As I said, that's their job, and their bosses just say, right, I want you to let us know what you think is going to happen to equities, bonds, foreign exchange, commodities, etc. in 2020. And generally, you know what, across the board, they're not really that correct. I'm not sort of saying I'm any better. I'm actually saying, really, like what we do here at Trend Signal is we analyze price action. We're not here to guess what the markets might do in the following year. It has been an extraordinary year. Let me just run a few slides if I can find them. Here we go. Okay, yeah, here we go. So global stock markets. We're starting off with Europe. I like Europe first. Um, European indices have rallied significantly this year. And the reason why I've mentioned it is because Europe was viewed as a bit of a basket case at the beginning of the year. Italy was in recession. I think Germany's diced with recession. It's extraordinary, actually, that it's not in recession, even following the really poor PMI numbers. It might still turn out to have another negative quarter uh, of negative growth, I should say. But there are signs that it could be turning the corner. But look what they've done look what they've done. European equities, the Stoxx 600, so that covers the whole of Europe, up 24% this year to date. And it's the third best in 20 years, which is extraordinary. And even weirder, if in every year that's got a 9 in it, it's done really well. So it's the best year in 20 years. The previous bests were in 2009 and 1999. And the third best one is 2019. Weird, isn't it? It's a bit like wine. You tend to get good vintages in double O's and '05 dates. But anyway, so an extraordinary turnout. But what about the other sort of global markets? Let's have a look at the next slide. FTSE. Now, FTSE, I remember looking at this at the beginning of the year. FTSE was down. All the markets were really weak following that sell-off in December last year. Look at the FTSE. Even the FTSE's managed a 13% rally. Okay, quite a bit of that has been in the last couple of weeks or 10 days. The DAX, an almighty basket case in Germany, up 25.6%. The S&P 29.25%, Dow 22%, Nikkei. The Nikkei, underperforming Nikkei, was still up close on 20%. Bonds also up, i.e. yields down, although the yields have rallied and bonds have fallen in the last quarter, but they've still done extraordinarily well. You wouldn't normally expect equities to go up and bonds to go up together. It's weird, but they have done. They have done. Commodities, well, gold up 16%, an extraordinary move, really. Bearing in mind there's almost been a bit of a softening in global macro events. There haven't been so many potential firestorms there, whether it be ISIS, whether it be North Korea, whether it be China, whatever. So there haven't been any major global macro events. And oil up 23%. Well, we've looked at that chart just in the last 10 minutes, quarter of an hour. It's been relentlessly rallying. And it's just because everyone's quite optimistic about next year in terms of recovery in China with the sort of a bit of a rapprochement in the US-China trade talks, etc. But there's still a long way to go. And we've got the world's largest economy, the leader of the world's largest economy, about to be impeached. Whether that will not happen in the Senate, the Republicans will chuck it out. But we have got the bizarre situation of having an impeached president of the United States running for a second term. You couldn't script it really, could you? But then again, it is Boris Trump, so that's probably the reason why. Anyway, what about some predictions for the coming year? Before I do this, I always like to look at the surveys that we take, that we carry out at the end of each year. And this is the end of last year. And we asked a number of questions about, and we gave levels on the FTSE, and really most of them were sort of when the FTSE was down at 6,700, we said, is it going to close below 6,700, 6,700 to 6,900, 7,900 to 6,900 to 7,200, then 7,200 to 7,500. So, but just 7% predicted that we'd be where we are. And you know what? I'm not surprised because it looked horrendous at the end of last year. Brexit in all sorts of turmoil, nothing happening. Stock markets have been really shot to pieces in December. But look, FTSE, even the lowly old FTSE, which has been the massive underperformer in Europe, has underperformed big time, but it's still got up 13% this year. UK oil, another one where most people did not predict much of a move here, especially with the US-China trade war carrying on. 23% predicted a price above 65 bucks. Most people did not expect it to get up there. Well, the euro, well, most of our attendees correctly called the 110 to 115 range on the euro. So that's 46, nearly half of all the respondents got that correct. So that was interesting. Sterling, well, you can just see why that is with Brexit, with everything else. 25% predicted it would be higher than 130. Virtually everyone else predicted it would be well below that. And some of the predictions were actually below 1-to-1. So you can see how bearish everything had got this time last year. And gold, well, 33% predicted greater than 1325. I'm sort of surprised how high gold has gone. It's sort of promoted by gold bugs, really, and it's not something that rewards you greatly, gold, unless someone else is prepared to buy it off you for a higher price. It costs to insure, it costs to store, it has to be financed, and it doesn't pay a dividend. But that's just me being a bit negative, really. But that's gold for you. I did ask a few questions about other things, and a couple of them here. UK Prime Minister, that's really interesting. And I didn't expect Boris Johnson to be Prime Minister this year. I just thought he wouldn't be able to carry it off. And that was the response. That was a sort of view amongst most of the people we surveyed. 11% expected Boris Johnson to be Prime Minister. And just for the record, most people expected Theresa May to still be in power. Good job, she's not. We've got a proper leader, whether you are a Tory or Labour supporter, at least we have a leader. Let's hope he makes the right decisions. What? Major global events. Well, we say what are going to be the major global events in 2018? We had a few selections, but the biggest one I think was chosen by the majority of people. 52% anticipated that the US-China trade war escalation would be the most destabilizing event. We didn't really get many destabilizing events, did we? There were very, very few. We talk about these black swans. It just didn't happen. And it didn't happen. That's just the way it is. Surprises, we don't know what the surprises are going to be because they are surprises. But central banks cut rates in 2019 to head off a global recession, and markets tend to anticipate what might happen up to 18 months ahead. And to try and work out what's going to happen next year, you could be maybe tempted to say not a lot's going to happen. Maybe stock markets will carry on going higher. That's probably the majority of the view. Bond yields may start to firm up, i.e. bonds might come off. And most investment banks and economists are sort of predicting that the dollar is going to fall this year or next year in 2020. Let's just go one slide down. There you go, predictions. It is a bit early, but shares up modestly. They tend not to go for anything too dramatic at this time of year, but a modest increase in shares. Bonds down as yields start to tick up. The US dollar down. And do you know what? I think it's a very risky business betting against the dollar, certainly in the new year, when the dollar tends to do quite well in the first 2 or 3 months of the year. So I would hold on to that particular bet until you see clear signs of it. And that's in the charts, not in anything you read, etc. It's price action that we really want to drill down to. Yeah, what can go wrong? Well, what can go wrong? Here, that's what can go wrong. I've put this in here. We've talked about volatility before. The Chicago Board of Options Exchange has a measure called the VIX, and I know I'm preaching to some people who are converted, but the VIX is what's referred to as a fear and greed index. But you'll notice on this chart we are plumbing right down to the lows again. At the beginning of the year, golly, the market it had been up to 40 in December last year, but it then subsided, and we only had a little blip in August. You remember the August sell-off in the stock markets, but that's gradually been unwound, and we are back to the stage now where very few investors and asset managers are taking much protection. It's all getting a little bit complacent again. So I ask you, is it safe to conclude that the markets are going to go higher next year? I don't know. I really don't know. And you know what? I'm not the one to ask anyway. In fact, most analysts aren't the people to ask. But the tea leaves mean, certainly looking at the VIX here, suggests that the market is very complacent going into the new year, which basically means if there is some sort of turbulence, and whatever that surprise is, I don't know, because it will be a surprise, whether it be something happening in China, something happening in the US. Golly, could Trump really be, could he actually be prosecuted in the Senate and actually be found guilty? At the moment, it's unlikely, but there are other bits of damning evidence coming to the fore, and you just never know. So it's going to be something that's going to be unexpected, isn't it? The markets are going to do what they're going to do. We here at Trend Signal, we prefer these things. These things are called charts. This represents price. This is price action. And the old phrase, the market has spoken, were you listening? This is what we trade off. It's what the markets are telling us, not what an analyst or a central banker or someone who writes a long view over a long period. We're more interested in what's going to happen in the short to medium term with our markets, and that's why price action and our charts are the most important, really. That's it. You've been a very quiet bunch, but I know that we've had quite a few questions, not of late, but we're coming up to our 12 o'clock cutoff. I did say it'd be maximum half an hour, but thank you very much for listening. I'd just like to wish you all a very happy and peaceful Christmas, whatever you're doing. Did you, Jeff says, did you ever use the Hindenburg omen? Golly, no, I didn't, Jeff. I'm going to be Googling that when I finish. But Jeff, that's interesting. Hindenburg omen. I will look that up. Hindenburg omen. Thank you for that. I will not be running a podcast this time next week. We've already mentioned that at the beginning of the piece. But so I guess I should also wish you a prosperous new year as well. Thank you very much all for attending. We appreciate you following us, and we look forward to carrying on with our podcast in the new year. Thank you very much, and bye for now.